bit of what it was about. And indeed, I would like to give you an update on how the ad market in Europe, and in particular digital, is now faring in this very unique time that we're in. And some of you may have followed my other talks, where at IAB Europe, we give every 6 weeks an update on the situation, because we're in really challenging times. So I've been an advertising forecaster for around 10 years, and never has it been this hard to anticipate the future, because things change so quickly. And this recession that we have is completely unlike any other, because there's so many different factors. There is, of course, the economic impact. There is the policy impact. There are virological considerations, local lockdowns, and so forth. And all these things thrown together make looking into the future of advertising extremely hard. But we're now in a much better position from an inside perspective than we were just around 2 months ago, because we now have the second quarter company results from all listed companies. That's really useful for us, because there's a consensus in the market that the second quarter so far was the bottom of the recession. So if we understand what happened in the second quarter, we can make much better predictions of the depth of the recession, and also about the pace and the cycle of the recovery. And what I would like to do today is share with you a few slides on how our thinking at IAB Europe has evolved over the last month or so, to see where we are and supply you with some numbers. I say straight away, please do take those with a pinch of salt. All forecasts are built on shifting foundations. So we will continuously re-update and reforecast as new information comes to light. But I hope this gives you a basis to understand what is going on. I will share my screen now to dive into the presentation. Here we are. You should see my screen now. Please do shout if you do not see it. Right. So there are exactly kind of 5 topics that I would like to discuss today. What's the macro environment? So what has happened with the economy? How does that affect advertising? What are we seeing then in advertising? Let's look at the Q2 results. Let's have a new outlook of how's the recovery going to look like. And then let's see, beyond this daily business of the recovery, what underlying structural changes are we seeing in the market? In other words, it's increasingly clear that we are not just looking at a recession and the recovery, but that in all of this, the nature of the market that we're in, the digital ad market, is profoundly changing. And this is giving some exciting new opportunities if we look at 2021 and beyond. So let's dive in. And this is a wordy slide. You can I'll share it with you after, but I just want to show you that there are very different ways on how we can make sense of the future. There are different methods available. Let's look at the left side. We could look at the economy and do correlations between GDP, household consumption, and all of these things, and ad spend. This is great, and it's a tried and tested approach. I've used it for a long time. But of course, now with COVID, things are becoming quite volatile. So the correlations might not always work. Financial analysts, so those who evaluate the performance of companies, equity analysts from banks, they mainly use the second thing here, a sectoral impact model. So let's say an analyst in a bank wants to assess how much Facebook or Google or a big broadcaster is affected in different countries by the pandemic. They would look at the share of ad spend from a given category, automotive, insurance, FMCG, and so forth, and then calculate, is that sector continuing to advertise in these times, or is it not continuing to advertising more or less, and then building an impact out of that. That works well for specific companies, but not for the ad industry overall. And as I will show you in this presentation, we can't just think that every sector is behaving, or every company in a sector is behaving the same. We see huge differences between individual companies. We can also do industry expert interviews and so forth, which are great to give color and depth, but it's very hard often for people, even experts, to abstract from their own position and apply that to the overall market. The last thing is an analysis of financial filings. This gives fantastic readings, and I'll do some of this in this presentation, but it's slow, it's lagging behind. So we can only be extremely reactive. What we've built at IAB Europe is a combination of macroeconomic modeling, the industry expert analysis, and financial filings. And all I show you today is the result of the combination of these three methods. Just a reminder. So we all know ad spend is correlated with economic growth, and it's a very strong correlation. You can see here this R squared value. A perfect correlation would be 1.0, and 0.86 shows it's very strong. There are three factors: GDP, household consumption, and industrial production. Household consumption, of course, makes sense. Goods that are produced and industrial goods that are being bought, and industrial production, goods that are being put on the market. Now, if we take this data, macroeconomic data, and just apply that to advertising, things look incredibly challenging for us right now. So if we just look at the US data, and I'm taking the US here because we have a long history of advertising data back to the year of 1900. If we apply the latest GDP forecast to our timeline of ad data, it looks like we are facing the most severe ad spend recession since the Great Recession. And this is just the most positive IMF GDP forecast. If you look at the Deloitte GDP forecast, which is slightly more pessimistic, it could be the worst recession in the recorded history of advertising. So this isn't a good start to the year, and Q2 has been pretty dire. But to switch ahead, the good news is that this scenario as painted here is luckily, I think, not going to happen. So there's a silver lining for us. So let's look at the flash reading of the actual economic data. So we now have across Europe the actual Q2 economic data. And at first, the economic data seems to confirm these kind of concerning statistics I showed before. Indeed, overall in Europe, we saw a massive drop in GDP, much more than in the financial crisis of 2008 and 2009, which you can see on the left of the slide. So it's more than double the decline. And that means we could be in for a very, very deep and severe ad recession. And indeed, we can see if we look at the nominal GDP across countries, here's an example of a couple of countries that we were able to obtain via Eurostat. We can see that nominal GDP was down significantly in all markets. The good news is for Romania, if you compare it, it's better than average, bang in the middle. And the remarkable thing is, if you look at the composition of countries, you see predominantly countries that had a very severe lockdown and that were very strongly affected by case numbers that were suffering. Spain, the UK, France, and Italy suffered most. But, and this will be a story throughout my presentation, you see that Eastern Europe has fared relatively better economically, and we'll also still see that now in terms of ad spend. Now, the situation about the economic impact overall has gotten worse over time. So here you see three different times when the IMF, the International Monetary Fund, did a forecast on how GDP globally will look like in 2020. In January, they of course still thought there was growth. For a long time, we were running on the new minus 3.0% assumption for April. But in June, they had a new update and they revised downwards to minus 4.9% because they realized the recession is deeper and the recovery is slower. Longer lockdowns and a more severe impact on the economy than even some of the most esteemed economic experts had anticipated. But things are very volatile. It could be better or it could be worse. So here you see a chart also from the IMF which say, based on this minus 4.9% scenario in 2020, things could be, when you look at the recovery, it could be worse. for instance, if there's a second outbreak, or it could be better if we're seeing a stronger than anticipated recovery in the second half of the year. So any economic forecast we have now has a lot of uncertainty with it. That also makes advertising forecasting quite hard. Now, a concern for us in Europe is that overall the relatively advanced economies, to which we count every economy in Europe, is faring relatively worse than the global average. So emerging economies, in particular in East Asia, have been faring better in this recession than how we have fared in Europe. So Europe is taking the brunt of this recession. You can see this by the revision of the GDP forecasts. Good news is, on the right here, by country, good news is that the majority of these revisions were for Western European countries, whereas Eastern European countries overall have not seen a downward revision in GDP forecasts between April and June, which is good news. Now, it's increasingly clear that if we look at the economic data, we are not seeing the entire impact yet. So here we can see, actually, if we look at the growth of employment rate, yes, we can see it's going down now, but we don't see the full magnitude. As we can see, if we look here on the left side, we can see growth in employment is down, but people are increasingly concerned about the economic impact of this recession. So Kantar here does regular study waves. Wave 1 was at the beginning of the recession, then wave 2, wave 3, and 4, and progressively people's outlook has become more negative. And that means that the recession that we're seeing is being flipped around. So previously, when we were all under lockdown, with a supply shock, there were no goods to be sold and no services to be consumed. So so the production economy was essentially at a standstill. Factories were being repurposed to provide hand sanitizer, masks, and so forth. But now that the economy is opening up, we're moving into a demand shock because people's wallets are being squeezed. Unemployment is rising and so forth. So this will be not as a sudden and deep recession, but this will contribute to a longer and slower recovering, a longer recession and a slower recovering economy. And now let's look at this chart on the left and blow this out. So this is the employment trends. And the concern is, as I said before, that if we look at employment trends overall, we're not seeing yet the real consumer shock yet. So in fact, we need to layer on the hours of work. So at the same time that employment has declined slightly, the hours of work have declined massively in most countries. That's predominantly because of furlough schemes, deferred redundancy, government support schemes, and so forth. As these are running out throughout countries, unemployment rates will surge dramatically. I'm not an expert on the Romanian economy, but you can see again in this data at least, Romania, Poland, and some other Eastern European countries are faring relatively better than some of the Western European countries. For consumers, though, this means that the real reduction in consumption and therefore impact or the ability to consume goods that are being advertised is only coming yet. So we can see on the left here from Eurostat a chart that shows that the savings rate is through the roof, with the highest savings rate since the millennium, since 2000, and people are consuming less. And this is unique because in most recessions, consumers, they tap into their savings, they rely on support networks of family and so forth, which means that consumption isn't affected that much, but it's being affected now because we've got this unique combination of factors. We've got social distancing, so people are staying apart from each other, the lockdowns, income losses, and a lack of consumer confidence, and this creates a perfect storm, really. So our main concern in advertising these days isn't the lockdown, but it is how much can people still consume. That affects certain economies, of course, in particular, big purchases like a car, a washing machine, holidays, and so forth are proportionately more affected by this than goods of daily use. And we're seeing that many economies are tapping into midterm challenges, and that is debt. Countries to fund furlough schemes, to fund redundancies and so forth, they need to amass debt. And that means that debt will be very slow to to return to normal levels, which means higher taxes and so forth, which in turn means consumers will have more, will have even less to spend. This has a midterm impact, which means even if the recession is over in 2020, recovery might be slower than anticipated. Now, what does this mean for advertising? So I looked at key company reports in Q2. We see WPP on the left, top left. We see ITV, the UK broadcast, on the top right. We see Merkel looking at Google search performance on the bottom left, and we see Omnicom on the bottom right. And you can see that the sectoral trends are quite, for ad spend, across the board, across companies, are quite similar to what I just described in terms of the overall economic impact. Where you can see, if you look at, for instance, at WPP on the left, sectors that are significantly affected is automotive, or anything in the premium segment, luxury segment, or travel. And you can see the same, for instance, if you look at ITV, when you look at the Q2 change, you see travel in Q2 minus 94%. You can see finance and retail minus 57%, car minus 70% nearly, and so forth. So very strong similarities across countries and media channels, TV, digital, and so forth. Now, many have asked what shape will the recovery have? And there are probably as many scenarios of this as there are letters in the alphabet. We usually talk about a U-shaped, a V-shaped, or an L-shaped recovery. And it's becoming increasingly clear that there isn't one letter to denote the recovery, but that different sectors and different companies will have different shapes of return to ad spend. So one is, if you look at V, we can see, which means steep decline and very quick immediate rebound. Technology sector, like the same as, for instance, what happened on the financial markets, healthcare, finance, home entertainment as we are locked in, and of course, online shopping for groceries and so forth. U-shaped, so slower recovery with a long flat period, but coming back to normal levels is packaged goods, in particular things of higher expenditure levels, and automotive, in particular as individual mobility is having a renaissance, if you will, as people are scared of going into public transport. But then sectors like travel and hospitality, we see will have a longer impact and will struggle to recover even in a couple of years' time to full pre-pandemic levels. Now, as I mentioned earlier, that we shouldn't just think about categories, but we need to look also at individual brands because there are exceptions. So here are three statements from from key brands in April 2020. Procter & Gamble, Mondelez, and Unilever. All in the FMCG category, but all of them have very different approaches to the pandemic. So P&G said, we need to spend more. Now we need to be on screen. Advertising now is cheap, it's affordable, and people need our goods and services. So this isn't the time to go off air. In particular, they doubled down on television. Mondelez, different product portfolio, moved also, doubled down on paid media because they wanted to get into online orders and also snacking, as I said here, but primarily online orders. And Unilever, which has a higher reliance, for instance, on ice cream than P&G, was actually freezing ad spend. And if you look at Coca-Cola, which I don't have on here, they went entirely dark, stopped all advertising, and only returned to the screens a couple of weeks ago. So we cannot always treat every company in every category the same. And that for marketers, for agencies and for publishers means we need to understand the individual requirements and needs of a brand and help them and go after them in these moments and not say, okay, a certain category isn't investing, we shouldn't be talking to them. There is opportunity even in a downturn. For us in digital, something that's often overlooked. It's not necessarily the big advertisers, the P&Gs of the world that are driving the digital economy, but it's primarily small and medium-sized businesses. So if you look at the very left chart here, the bubble, the pie chart, you can see that overall, over 50% of all ad spend comes from the major marketers, the big companies that we all know of, the ones who advertise on TV, on out of home and so forth. But the small and medium-sized businesses have a strong share. Now, if you move in the middle and look at the exposure of small and medium-sized businesses to digital, it's much higher. So around 72% of digital spend comes through more small and medium-sized businesses. And search and social is even higher, which means we as a digital industry need to ensure that the small businesses are thriving or succeeding in this recession. Because if they go bankrupt, it will have a massive knock-on effect of digital. And right now, digital, from an ad spend perspective, is faring better than other media, just because in contrast to a big marketer, these small and medium-sized companies, they need to continue to advertise in order to sell goods. If they stop advertising, they won't sell. There's a much more immediate combination. Now, if we look at company reports, we can see in TV here an extremely consistent picture across Europe. So here I looked at the major listed TV broadcasters in Europe and looked at how was the ad spend decline in Q2 2020. And it's remarkable that it ranges between minus 46.3 and kind of minus 30%. So everyone had at least 1/3 of a downturn. Something that's remarkable though is again that in Western Europe, extremely similar, minus 40% and more. But if you go to Eastern Europe, Polsat, the Polish broadcaster, or CME, which is of course in Romania, Slovakia, Slovenia, Czech Republic, Bulgaria, a much better picture. So Central and Eastern Europe has been faring better also in the TV space than Western Europe. We could see some initial readings in these Q2 company reports about the recovery, although companies were very cautious when being pressed by analysts for questions. And one of the key learnings is we are not in television seeing a return to growth. So there's no reason to party, but it's getting better. So Q3 is going to be less worse. So ProSieben says around minus 20 in July, August slightly positive, but unsure what's going to happen in September. RTL in aggregate, well, Q3 could be minus 10%. And we see in Italy and Spain probably a low single-digit decline in Q3. The most important thing for television across the board will be the fourth quarter, because television is heavily geared towards the Christmas period, which means the last 4 months of the year make around 50% of revenue, which means even if the picture looks bad now, there is still a massive potential, if things go well, to recover a lot of the losses and drive the ad market up again in Q4. If we look at the digital results, we can see a very interesting picture, and which is much more heterogeneous, much more different, less clear than on the TV side. One thing is Jeff Bezos is laughing all the way to the bank. We could see Amazon, despite us being in a recession, posting advertising year-on-year growth, so compared to the same quarter of the previous year, of 40.6%. And this really highlights this shift to e-commerce and the combination of advertising and e-commerce, of leveraging user data and shopping data from users for advertising, of using advertising to increase the search rankings on the Amazon store, of driving people to the Amazon store, and so forth. We're seeing, if we look in the social world, overall, this is global revenue, by the way, we didn't see a decline. So Snap, of course, saw a lower revenue growth, but people, in particular adolescents, were online looking to interact with their friends as they couldn't meet them. So there was still a healthy growth despite reduced marketer budgets, because engagement was so high. And it's a hard to reach audience group, and they have been online a lot. Also, Facebook didn't post a decline globally, as SMEs in particular flocked to Facebook, and also the boycott of some brands around Black Lives Matters and hate speech didn't lead to a decline, because Facebook is so reliant. They have 8 million different advertisers, so reliant on the small and medium-sized businesses who need the reach, tools, and the infrastructure of Facebook to sell and to stay alive. But another social platform, Twitter, which focuses more on brand budgets and less on performance and direct response budgets, was doing much, much worse. And also, we could see we don't have that many programmatic companies being listed. Magnite, so ex-Rubicon, now Rubicon and Teleria, together under Magnite is one, but the Trade Desk is another one. We saw the Trade Desk posting declines of 12.9%. It would have been worse if it wasn't for connected TV. So we can assume that the display programmatic ad market was down by more than 20, 25, or 30%, depending on the market. So which means we are now in a 3-speed digital world. We've got Amazon and e-commerce based advertising in a class of its own. Then we see social performance, and then we see the rest. What is remarkable is that if you look at Google, Google also declined. So the search market is very mature, and search budgets, in particular because of its high reliance on travel, were severely impacted. But that only tells half the story, because YouTube was still growing. But of course, the programmatic business that Google has also invested in was suffering. And we see kind of open market, non-platform programmatic suffering more than social. Now, the good news is that I think in particular programmatic can and will recover very, very quickly, because it can be turned on very quickly. Looking at the agency results, we can see different trends by region. So on the left, I try to classify the decline that a given agency sees in a given region to see whether there are some patterns. And you can see overall, so we've got 5 big holding companies here. Overall, America was doing the best, and then together with Asia Pacific, and Europe and the Middle East and Africa were most severely exposed, mainly Europe because of the severity of the lockdowns. Important to note that in these agency results, it's not just ad spend as we define it, but there's also CRM in there, PR, there's paid for media, there's creative in there and so forth. And the agency performance, you can't compare one-on-one because some agencies in some regions are more reliant on non-paid media than others and so forth, but it gives us a good indicator. But we know that media spend was generally performing the worst. And if you compare on the bottom right of the chart, you can see that Europe and Middle East constantly the worst performers for each agency group. Now, we've got some readings from Publicis, Omnicom, and WPP on a by-country performance. I'm not going to go into the details right now, but one remarkable thing we can see is that while Western Europe was down pretty strong double-digit, look at Eastern Europe performing much better again. If we look at the outlook, agencies also provide an outlook, there's reason to be hopeful, but we need to be extremely cautious. So here we look at WPP, which provided Q2 results, but also showed how July was performing. And you could see in all countries that July was better than Q2. So supporting the thesis that things are getting less worse, as broadcasters were saying as well. The issue is some extremely exciting news, like in Italy, a return to growth. But you could see Spain, for instance, that July wasn't much better than Q2 overall. And we know that the bottom in Q2 was in April. So it might be that it's likely that July was worse than June. Why is that? It might be because of local lockdowns. So we can see any recovery is extremely volatile and things can change extremely quickly. And how are agency leaders seeing this recovery? I mean, there was a nice texture in the calls about this. So Mark Reed confirming this thing about Spain. So being very, very cautious. Publicis CEO says, well, yeah, even we saw June being worse than May. So there isn't a clear recovery trend, or there isn't a trend as clear as we would like to see. We can't say yet whether we would see that much anticipated recovery in the second half of the year. Michael Roth says, yeah, things are getting better, but there's extremely low visibility about July, August, and so forth. We can't say it for sure. Dentsu, looking at Japan, but also looking at globally, says we're expecting H2 to be bad as well. We are extremely conservative in our planning. And the recovery will only be in 2021, but it will be gentle, not a massive recovery. So linking back to what I said earlier about the IMF macroeconomic forecasts, a deeper recession, and slower recovery. Last but not least, Martin Sorrell, who in his own language was much more upbeat, his agency group is focused purely on digital. So we can infer something for our industry here from there. Sequential recovery, Q3 better, Q4 even better, and then return to growth in 2021. So for digital, the story overall looks more promising than for the rest of the ad industry. And indeed, yes, the digital results, when I look at them in my model, they really reflect company results. We can see, if we look at social in Europe, there was no quarter where social spend was negative. It's continuing to grow. Search impacted, but not that severely. Then video, because branding. Banner display, severely impacted in digital, but other media even more impacted. Out of home stopped entirely, print down, TV we've seen -40, -37%, etc., and a gradual recovery. But there's one remarkable trend, and this for me is the news I really want to give you on your way from this presentation. I've talked at length about the worsening economic outlook, but something remarkable is happening now, which means that the worse economic outlook we've seen from the IMF is not reflected in a worse outlook on ad spend. This is actually quite interesting. So let's look at the left of this chart, where you saw in 2009, during the financial crisis, GDP in Europe was down -4.3%. Ad spend down -12.1%. If we looked at the same ratio, the same multiplier, you would see right now our GDP, the GDP forecast is for 2020 -8.3%. We would have an ad spend decline of around -23.4%. Other economic models say for every 1 percentage point decline in GDP, there's a 5 percentage point decline in advertising, which clearly means the worse the economy, the worse advertising is going to get. But we're seeing something else. So on the right side, this is my actual forecast. Real GDP, if we assume -8.3, ad spend will only be down 12.9%, so only slightly worse than 2009. So we're seeing a breakdown of this historical correlation. Or we don't know exactly why, but there are a couple of things to think about. One, there might be a natural bottom where advertisers cannot spend less on advertising. So it might be that this relationship with the economy and advertising, it's not going indefinitely to the bottom. But I think there's some other factors as well. In contrast to 2009, where everyone was dependent on the financial markets, we've seen after an initial shock in the market that advertisers are learning to cope with the recession. Now with e-commerce, for instance, many can take their fortunes into their own hands, which is really, really useful. So people are learning to cope with the economic downturn, and they're developing individual strategies. And lastly, we have in digital in particular, all these new advertisers which weren't there before, on social, on search, and so forth. And that the volume of advertisers and their need to advertise in order to survive is also fueling the forecasts. So good news overall for digital. And here's a key quote I found from Magnite, which supports this. So they did a study. They looked at local lockdowns in the US and looked at, in those places of lockdown, is ad spend going down? And they realized even when there is a new lockdown, ad spend in that area isn't affected, which is good news for the rest of the year. Increasingly, there's a sense that the ad industry is learning to live with the pandemic. And that means, to conclude, if I look at my forecast revisions, we're seeing in April, we were all very, very bearish, very pessimistic. But now in digital, in particular, we're faring much better. So this is excellent news for us. And overall, it will take the economy to return to pre-recession levels 3 years. Here's .com crash, financial crisis, and Eurozone crash. We expect the same for all media ad spend this year. But actually, if we look at digital, we think it will already return to growth in the next year. So thank you very much for your attention. And if you have any questions, I look forward to answering them.
Thank you very much, Daniel, for this very interesting information you have shared with us, and you gave us some food for thought for the next couple of months that we have for 2020, and how to prepare for 2021. It's good news to see that we are on the right side of or on the right channel of the advertising ecosystem. I wanted to ask you, and well, perhaps break the ice for some other colleagues that want to ask questions. What about digital audio? How do you think that will evolve in the next month?
Digital audio has been a tremendous growth area in the last couple of years. We started to size the market at IAB Europe, and we think that by 2023, it's going to be a 1.3 billion euro industry, growing from around 300 million in 2018. So massive growth. But we saw a little dent in that growth curve in 2020. The different trends. Number one, there's an explosion of podcasts right now, and which is increasingly well monetized. That's great news. But a lot of consumption time has fallen away. In the old world of radio, it was always radio time as drive time. So the morning was always morning time. The commute to work was prime time for radio, or the commute back. But now that this is falling away, or has been fallen away in many countries, as people are working from home, audience numbers have actually been going down. And if kids were not in school, there was less time to engage with audio content. So the lockdown hasn't been great for audio, and we're only seeing it to return to growth right now.
Do you think that interest or a growing interest in legislation and regulation actually in terms of digital might affect the spend in the future, might affect more the spend in digital in the future?
We thought about this long and hard, and there are clearly some hurdles, with in particular privacy, but we're not seeing any evidence that it will reduce the spend in digital. We're moving away from the world of deterministic targeting, where we know the audience, to a world of probabilistic targeting, where we need to make statistical conclusions and inferences about who the audience is. This is a massive structural shift in the entire industry. But people will learn to deal with it and continue to spend on digital because there are few other options to spend. The key thing is to shift the industry mindset from the cookie-based world and knowing exactly what happened to an inference and probabilistic-based world. That will require education, but I don't see it affecting the overall volume of spend in digital. What is a more interesting question, I think, is how within digital spend is being reconfigured. We're now, of course, seeing, if we look at regulation and also consumer sentiment, we're seeing a techlash. We're seeing some of the large players being under consumer scrutiny. We're seeing also small players, anyone who isn't taking consumer privacy seriously. And companies, publishers, intermediaries, platforms who are privacy first, who commit to ethical advertising, they are about to gain. Where we saw kind of the whole world of ethics and clean advertising as a little niche area for activists just a couple of years ago, it's increasingly becoming mainstream. So just as brands have a sustainability narrative today, they want to apply the same narrative, not just to clean water and clean packaging and less plastic waste, they want to apply the same to advertising. And that's something that the industry has to get ready for.
Thank you. And you said about programmatic that it was a little bit influenced and suffered from this lockdown. Is it recovering soon, or is it until the end of the year recovery, or should we expect a more abrupt recovery for the beginning of the next year?
We're already seeing, the good news is we're already seeing the recovery now. So Q2 was really the bottom. And there are two factors that influence programmatic. Number one, it was incredibly easy to switch off. Programmatic is switch on, switch off. And that meant we actually saw a steeper drop in programmatic ad spend in March already than on TV, because you had longer term contracts in TV. You couldn't switch off immediately. But with programmatic, you could just push the button and stop it, apart of course from your PMPs that were running. And now we're seeing programmatic recovering robustly. It's not at the levels of social yet, which hasn't declined that much, but it is coming back more strongly. I think programmatic is reliant a bit more than social on agencies in particular. So if you look at Trade Desk, for instance, they are mainly serving agencies, which means that there's a stronger correlation between the recovery of the agencies and their client base on programmatic than there's with social, because social has more direct customers.
We have one more question. Taking into account that digital is steady more or less, even if people are on lockdown, how do you explain that people are still spending more time on mobile than on desktop? Any data regarding device online consumption in user behavior?
I don't have detailed data on that, but overall, yes, we have seen this long-term shift from mobile to desktop, from desktop to mobile for a long time. And increasingly, we've seen that a lot of mobile consumption is actually happening at home, because the internet connection is the best at home. And when people are not at their desk, but they're lounged on the sofa or somewhere, the mobile is the primary device. It works in more settings in the home than the desktop. So mobile doesn't mean out of home behavior, but the mobile has become a key in-home device. In particular, if you look at, for instance, games on mobile, if you look at apps and sites optimized for mobile, streaming service optimized for mobile, and so forth, we're seeing mobile even in the home being the primary device.
Thank you so much. Well, since there are no other questions right now, thank you very much for your time and for the information. And if there are other questions that might arise later, well, then I can send them to you. And also, you all can follow Daniel and IAB Europe and IAB Romania's communication, because there will be some other webinars dedicated to the updated information related to digital advertising. We'll also hopefully come with the ROAD's data, with the Romanian ADEX data by the end of the year. We'll start the collection in October for the first semester of 2020, and it will be interesting to see how the crisis and the lockdown has effectively impacted the digital. So have something very concrete to talk about, and a strong benchmark. So thank you all. Thank you, Daniel. Și noi vă așteptăm și la alte evenimente ale IAB România, deocamdată online, până vom putea face și evenimente offline în siguranță. Vă dorim să fiți bine, succes și mult spor în ceea ce faceți. Dacă mai sunt întrebări sau dacă doriți alte informații, eu vă stau la dispoziție. Înregistrarea acestui eveniment o vom face publică și, de asemenea, odată ce primesc și prezentarea de la Daniel, o voi share-ui cu participanții. Vă mulțumesc și vă urez o zi bună!
Mulțumim!